this is your support, and above here we have the resistance. What about the supply and demand? How do we draw it? Remember, the supply and demand, we are mostly focusing on what? On the body of the candlestick. The body of the candlestick shows that we are looking for the range. We are looking for the range, like just like when you did math literacy in school, that if you look at the candlestick that is like this, right? This candlestick, you can see that we have two candlesticks here. These two candlesticks, they have what? They have the supply. Now, let's examine this candlestick so that you understand better and have a better understanding as to how we mark the demand and supply. So we zoom in. Let's zoom in this demand here. These two candlesticks. And this candlestick is what we call the engulfing. And engulfing, it's important to know it's in market because it shows you what's happening between buyers and sellers. Now, when we compare this candlestick, the first one, it has a smaller body, super small. The second one has a larger body, so big. So now this is where we have our demand zone, because this is just practical. This selling candlestick has less supply, which means sellers were actually getting lesser and lesser. It's just us understanding the algorithm, understanding the printed candlestick, because this is just graphics. If right now we change to, let's say, a line graph, everybody will be lost, will not know what's happening here. But because of each and every time this line moves, if I make it like this here, I put my my arrow here, you can see that we have what? We have this pricing here. You can see we have open price, high price, low price, close price. So it's difficult to read in this way, but when we use the candlestick, it's much easier. You can be able to see what the patterns, and these patterns, if for you to be precise, not just no pattern, these are just patterns. Oh, I can apply them in any market. That is totally wrong. But you can get through that, right? Because the market is sometimes kind, sometimes it's cruel, but it does not care about anyone. It has to move. It moves however it wants to move. The only thing that we have is the only advantage is for it to reach here, because this is where we have the psychological levels that the algorithm respects and do some shifts, moves, and sometimes we make losses. But when we do make losses, we'll get into when we do make losses and when we do make profit. So how do we mark the supply or demand? Let's mark the supply. All right, let's look at the supply and look at the demand so that you can understand much better. Remember, on the supply and demand, we're looking at the pricing, the range. We're looking at the range, the open price, close price. We are comparing two candlesticks. We are comparing two candlesticks so that we can determine whether this is actually indeed engulfing or not. So let's go ahead and mark this one. Now we look here. When we mark an engulfing, or where we have an area of demand, we mark a border of the candlestick here, just like this. We mark the border of the candlestick. Remember, the border of the candlestick contains two things. Contains the open price and close price. So now when we mark the candlestick of a sell candlestick. You can see the selling candlestick has two things: open price above and selling price below. Let's zoom in to this candlestick so that we look at that. We have the open price above here, and we also have the close price here. So we mark this one, and when we compare it, the red one with the green one, we look at whether the green candlestick didn't start here. We don't want the candlestick to start here and engulf the red one. No, we want it to be like this. That is why I say take screenshots, make sure that you reference, because the next time you're trying to trade there, you'll be confused as to what's happening here. This is what you have to do. Reference. You compare. The comparing is giving you more access. And most of us traders, please, I want you to note this. We have more advantage because we're trading using the derive. We're trading the volatility. We have more advantage. Why we have more advantage? Because the algorithm there is not influenced by the news that are happening in the country. It's not influenced by the the investors, the companies. And remember that in Forex, we have many players. The central banks, we don't have central banks here. We don't have commercial banks here. We don't have the institutional companies that have some international trades reasons, like they want to do investments. We don't have that. In Forex, we have remember, if you must know this important. In Forex, most of the time when it comes to comparing trading forex and this is easier than trading forex. Reason why on forex we have so many players, the brokers, the the companies that we're talking about, companies that are big, like for example Samsung, Apple. And when we compare that, we also have the commercial banks that they have to do business in a daily basis, and they have to make sure that their currency is stable. So they need to do transaction in a daily basis, and they have reasons to make profit. And when we compare them to the governments, like the institutional, these ones, they are mostly focused on the investment reasons, the international trades, and the central banks, they are more into controlling the economy, in controlling the currency where it says it has to go in a certain time, maybe they say in a period time window. So that is why we have more advantage when we're trading the volatility 75. But other than that, when we trade the currencies, we can still make money because there's a real volume. And this why it this is where we differentiate what the volatilities, the synthetic indexes, the boom and crash and all that to currencies, because currencies they carry a real volume. If you see an engulfing candlestick like this, you know that okay, JP Morgan okay has made a transaction, but you will not see it, but you will just see it by this graph because they had do these transactions, and we have sessions in forex. Remember, we have sessions. We have the New York, the Asia, and the London. So they do these transactions because they open bank activities in a daily basis. So this is where we differentiate the volatility and the currencies. And currencies, we have advantage in trading them based on that scenario because we have real volume. So here, if you study volume, you will not get a real volume because this is just algorithm driven chart. Is not actually something that is actually carrying real volume that someone bought what, someone sold what. No, it doesn't carry any volume. It's just a system-based thing. But here we have more advantage to do analysis because of what? Because of this volatility is constant. You can see the constant here 75% or volatility 100. So this simply means that if it goes up 75 or it goes out 100%, 75% of the time it will go back and retrace. So you have more advantage when it comes to trading this. But still, on the currencies, you have more advantage too because of you have what? Real volume. And when you see something like this, you are guaranteed for sure that this will happen because of what? Because of the volume there. So it's much you it's all up to you now. I'm giving you this information so that you can actually make this decision so that okay, now I see Bozza is telling me something that is actually critical here. Now I understand and I'm gonna use this information. So I don't want anyone to actually be left behind here. So if you have questions, ask and I'll be attending you now. So we looked at how do we draw? Let's continue with drawing. We draw what? We draw it like this, in this way. So we can also draw in this way. You can see here above, this is where we have what? We have our supply. We draw what? The candlestick range. Simple. So now, let's go into entry before we combine everything together. Let's go into entry. How do we confirm an entry? But before we go into entry, I'm now open to questionings. If anyone wants to ask, feel free to ask me. You can unmute your mics, ask questions so that I can attend to you and give you what you need to know. Questions? Any questions? 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 Any question? Lungiso, Tabo? Any question?
I'm good.
Oh, you're good. Okay. Lungiso, question? Okay. Question? All right, we can continue then. Since there's no question, we don't have any question. All right, okay, let's continue to entry. And before we end our session, because we're already past the time. Okay, now let's look at entry confirmation. Let's delete everything here. Before I want us to combine everything. All right, let's look at entry confirmation. Entry confirmation, how do we confirm an entry? Right, let's actually zoom into a smaller time frame. So remember, when we confirm an entry, we use the time frame 1M to 15 minutes. We're not using 30 minutes, right? We're just using maximum to 15 minutes. All right, so now we can jump into a smaller time frame, 15 minutes, and look for this candlestick that they really confirm an entry so that I can show you what you really need to know. Now, let's jump into a candlestick. I want to actually look at those candlesticks that we can that you can actually pay attention to and note this. All right, let's look at this candlestick here. We can zoom into this candlestick. All right, these are the candlestick that we're looking for. Engulfing, still the same thing that we use in a higher time frame, but now we're using it in a smaller time frame. So when it comes to confirming entry, we use engulfing candlestick. But we're not just using engulfing alone, right? We have engulfing candlestick is just we can say a multi candlestick, right? Now we have a one candlestick that we can use. This candlestick that is like this. Now, when we study a candlestick tells us what is happening, what is really happening. And when we're trading Forex, since it carries a real volume, what is happening in Forex is equals to true. What is happening here in statistics indexes is equals to true. But you need to understand, because in Forex it's easier. You can just look at an engulfing and say, oh, this is engulfing, is buying, we're buying. We can buy. But when it comes to trading the synthetics, you need to be precise. So even if right now you take it in this way, say, okay, I see engulfing, I want to buy. How do you buy? When you buy, each and every time you buy, let's keep this thing basic and simple and logic. A question? You have a question? Someone has a question? A question? Okay, no question. All right, we can continue then. All right, let's look at the candlesticks. Now, when you look at the candlesticks, we're looking in terms of how to trade it. All right, we can trade it using what the engulfing candlestick. This is just a two candlestick. We can trade it using what? Using just a single candlestick. But how do we apply this candlestick? We need to actually understand how we align everything together. So before we use the engulfing candlestick, we need to understand the sequence around it. We need to understand what the sequence around it. When we look at the engulfing candlestick, and engulfing candlestick is not just engulfing candlestick. Remember, this one shows that what we are having more demand than what than the supply, because we have a red candlestick that is small and a green candlestick that is big. Simple to understand. Now, how do we actually understand the sequence around this? Remember, it's important to also always take screenshots. We'll get into this candlestick, how you use it, how we apply this candlestick to confirm whether we are buying or selling. So now, when we look at engulfing, there are many ways to use engulfing. There are many ways to use engulfing. Now we use engulfing in this way. We can count one candlestick, second candlestick, and third candlestick.